Hello, hello, welcome back. In this video we are talking Tesla, a company that I don't hold in my portfolio, but I would love to, at the right price, right? Now, it's been down 60% and this is music to my ears. Is this the time now to be buying this company? It used to be 400 bucks over here if you take a look at its 1 year high. I think it was even higher at some point. But the current price is sitting at $161. And now it may be the time to potentially add to a portfolio. Is that really the time? We will examine that. But let's first try to understand what is going on, what are the risks and what are the concerns around Tesla. I have an article here which outlines some of the issues very nicely over here in terms of the risk for Tesla to shareholders. Recent customer surveys show brewing trouble, as you'll see. The results of its November Tesla survey, which found that more respondents now had a negative view of the brand than a positive one. So it's getting less, I should say, popular, Tesla is. And the thing is, this is very problematic because a big deal for Tesla and a big reason why the stock has been going up was its popularity and not its financials. So as you can understand, the brand perception plays a big role in the stock going higher is the big thing here. Now, why increased favorability among Republicans may not help, and what the article is saying here is basically the fact that, as you'll see, we don't have a strict party breakdown of Tesla owners. We do know that nearly 40% of Tesla's US sales last year were from California. And since about half of Tesla's sales come from the US, that means about 20% of current revenues from California. And it's a democratic state, as you know. California is one of the big democratic states. And that doesn't really help because Democrats seem to be, feeling a little bit worse about Tesla, I should say, lately. Now, there is also no margin of safety. We have talked about it, like a very high PE ratio for the company, an expensive company. It's been for a while now. Now, is that still the same? The same thing that what it used to be like a year ago or a few months ago? We'll see. We'll examine that a little bit later in the video. And yeah, there are risks also about Twitter. Like Elon Musk basically sort of like having some political debates and talking about censorship and getting more and more involved with Twitter. Some people are scared that he may eventually abandon Tesla as a whole, maybe even sell the company. And so this obviously brings some scares to investors, and some people are actually looking to lighten up their holdings here. So again, makes a ton of sense as well, based on the price of the stock and based on the price action, the current price action right now. Of course, great cars, risky stock is what the article is saying over here, is what the article is mentioning. Now, what about the actual financials? A P ratio of 48% dropping precipitously. Great to see. Look at where it was like back in 2020, more than 1,000. Ridiculous. And the price to free cash flow that is still 146 though, even though it's dropping. The company is a company that is very, very capital intensive. As you can understand, insane capital expenditures. This is why the price to free cash flow is that high. Outstanding shares, of course, the company has been printing shares like crazy because that's what you do when your stock price is extremely expensive. You print more in order to gain more capital. And a company of this sort, selling cars pretty much is very, very capital hungry. And, it's a great opportunity to be issuing shares. That's what they are doing. They also have quite a few liabilities compared to the free cash flow, not an insane amount though. And they are growing their revenue, sure. The growth, net income, free cash flow, it's a company that is growing tremendously well. Now the total equity is coming from the outstanding shares for the most part, of course. But still, it is a company that is growing and it's actually positive. Now the net income margins right now are becoming more and more positive, which is again a great thing to see for a company of this sort. So it used to be negative. This is a trajectory that is a good trajectory. It's a nice trajectory to see. Now, will that continue in the sense of pretty much positivity, in the sense of positive net income margins? I think the company will continue being pretty much profitable. Now, the thing is, what about the stock price? Like, does it actually converge with this kind of diagram? Does it actually make sense? We will examine that. Okay, so what else in terms of the, pretty much the financial statements of the company? Let's see what they have been doing in more detail. From 11 billion in revenue to 53, so almost 4 or 5 times as much as revenue, pretty much as in 2017. So tremendous increase in terms of the revenue that the company has been achieving, And the net income, again, it's a nice picture. It's getting more and more positive. So if you're buying a company that is negative in terms of the net income that they are generating, you should at least see a trajectory towards profitability. That's exactly what we're seeing over here, and at least that's a good sign. However, of course, if we were back in 2019, you would also have to account for the stock price, because if the stock price was having a PE ratio of 2,000 or 1,000 or whatever it was, it didn't make sense to be buying back then, and it is only because of the sentiment that the stock has been going up, not the financials. And of course, this at some point reverses. This is why the stock is down a lot right now. And there's also a lot of risk because there is no, again, margin of safety over here. Again, it's even though it has dropped 60%, it's still expensive, is the thing. And in terms of total equity, from 5 billion to 31 billion, a lot of it pretty much additional paid in capital because the company has been issuing a ton of shares, as you can understand. Now, the cash flow statement is the next one that we're going to examine. From losing money to 5.5 billion in net income, that generates about 11.5 billion in operating cash flow. And the stock-based compensation, 2 billion and 3 billion in depreciation amortization, makes it, this is about 5 extra, as you can understand, being added back to the net income, and generates about 11.5 billion in operating cash flow, which takes it to 3.4 in free cash flow because of the capital expenditures, because the company has about 8 billion in capital expenditures as well. Okay, now, what about the price of the stock? Is it expensive? Is it cheap? This is what we're going to be examining next. This is very, very important because we need to know whether the company is a buy right now. That's what we really, really care about. Should we be buying it already or just wait a little bit? Before we jump to our stock evaluation tool, pretty much, I wanted to take a look at a rival. Let's just take a little bit of a quick look at Ford. Now, this is F, not Ford. Actually, Ford is another stock. F is the Ford Motor Company. And I want you to take a look at the financials, like a quick look at the financials of Ford, which is another company that is making electric vehicles, of course, among other vehicles. And it's an older company, a company that is also super popular. You'll see that it has a P ratio of 6 and a price to free cash flow of 5, which is a ratio that makes a ton of sense for a company of this sort, like a car company. Car companies tend to have low margins and tend to be much, much lower in terms of their pretty much valuations. Yes, this has lower margins than Tesla because Tesla is also having some software sales and things of that sort, so their margins are higher. Yet they are still a car company for the most part, unless something drastically changes. So it's the fact that their revenue growth has been nice in the past few years, and pretty much they have been a name to become a big player in the space. Tesla is what took them to their valuation, their current valuation. But always remember that Ford is like a 6 in terms of its P ratio, and Tesla is a 48. And it used to be even higher at some point. Remember, it was like, we examined it earlier, like more than 1,000. So as you can understand, this is a very, very expensive company. At least it used to be, and it still has a pretty high P ratio over here. Okay, now let's jump to our stock evaluator then and see what kind of price it makes sense to pay for Tesla. Now, the revenue growth of the company has been insane. Of course, they have been growing at a tremendous pace. We're going to have to go lower. We cannot continue with this kind of growth for our projections. This would be insane, 50% on average. We're going to go maybe 10, still high, 10, 14, and 18. Not sure if they're going to achieve that, but let's just say that they do achieve that. Net income margins of, as you'll see here, 10%. Lately it has been a little bit higher. We saw it close to 15. We're going to go 12, 14, and 15 here. We're going to be positive. And free cash flow margins, you will see here that in many years it was negative. Over here it's becoming more positive and pretty much coinciding with the net income, which takes us to about 60% over here. I think it's going to be probably something that is typical. 80, 90, and 100, I think, is what I'm going to be using. 13% for our annual return. Let's see what we get, what makes sense to be paying for this company. And as you'll see, it's still very, very expensive at $160. Again, it's also here. You will see that everything is red, even with metrics and projections that are fairly aggressive here. We are still getting a low of 33. a medium of 51 and a high of 72 over here, which is far from the current price of 161. So still expensive, and very much so. And if we go with something that is more conservative, and we went with something like 8, let's just say 8, 9, and 10 over here, and margins that were lower, close to what the company did last year, 8, 9, 10, which could still happen, then we will be seeing an even lower price, so like 20, 27, and 34. So I think what makes sense for Tesla is something near maybe 40 to 50 bucks. Anything more than that, it's becoming expensive. Now, like 65, maybe it's okay. But, if you go near 160 or maybe even 100, this is going to still be expensive. So let alone 160 as it is right now. So I would have to wait. Even though I would love to have some Tesla in my portfolio, this is not the time yet. So if it goes lower significantly, then I'm going to be revisiting. But as it is right now, it's still way expensive for my taste. And I do think that this is going to continue going down for a while. We'll see, of course, whether that's the case, but that's what I feel. But thanks for watching. Tell me what you think about Tesla, whether you are buying or selling. Leave a comment below, of course, and I'll see you in the next video. Bye-bye.